2025 is a pivotal year for Soul Patts. We're merging with Brickworks and welcoming 25,000 new shareholders to our register. It's the culmination of a journey that we've been on to create a pure investment vehicle.
Jim Milner, famous for his corporate governance gem, the thicker the carpet, the thinner the dividend, ran the company for 50 years, and his nephew Robert has been at it for 20.
When I became chairman, I was the fourth generation of the Pattinson family to be chairman. And at that particular time, Soul had a market capitalisation of 675 million, and our market capitalisation has grown to over 15 billion. So there's been quite a dramatic growth phase over that period of time. Todd was one of the many bright young men that came along to join us. He was by far the best candidate that we could have picked, and I think what he's done in that period of time emphasises that. He's got a great vision on where he wants to take this company, and I've always been very supportive of him. And I'm very confident with the people we have. And you've got to remember, unless you have good people, and this company's had numerous people that have worked here for 20, 30, 40 years. We've had 3 families that have had 3 generations work here in the old days of pharmacy. So it's a people's business, and Todd's put a very, very good team here behind him.
When I started in 2004, it was a very different place to what it is today. There was about 15 people operating above the pharmacy in 160 Pitt Street. There was about a $1.7 billion market cap, and the portfolio was still very concentrated in Brickworks, TPG, New Hope and API.
After 4 generations, Washington H. Soul Pattinson remains one of the most remarkable conglomerates in Australia.
In 1872, Caleb Soul and his son Washington opened their first store in Pitt Street in Sydney. 132 years later and almost next door, these offices house an investment company with a reach that stretches from coal mining to television. Its primary investment is in Brickworks, the construction materials group. It's a complex web. Pattinson holds 42% of Brickworks, which in turn holds 48.9% of Soul Pattinson. The cross-shareholding has helped preserve the family's grip on the business, but some say the need for such a web is no longer useful.
With the cross-shareholding, we came under a lot of pressure from some people. These things happen when you're different.
What we saw in the Brickworks Soul Patts group was a collection of superb assets that were housed in corporate structures that, in our view, significantly understated the real value of those assets. We unveiled the proposal, and it fairly predictably met with very stout resistance from the boards of both Brickworks and Soul Patts.
In those days, you could tell people what you thought of them. I think we've got more important things to do with shareholders' money at the moment than taking each other over. I think what we've done in the last 5 to 6 years by releasing some of these shareholders' funds and assets, I'm more concerned on working on that at the moment than any takeovers.
I think it would be fair to say we could have done a lot worse than holding the various holdings that we had in both companies up until today. Both companies have been superb performers.
We've been able to grow both companies, and it's given us that protection that we could go ahead and do things without being intimidated by some of these corporate raiders, etc. It's guaranteed both companies certainty over a long period of time, and only recently we've come to the consensus that it's about time the merger ratios make sense. We thought it was probably a good time to put both businesses together.
2025 is the culmination of a decade-long process of expanding out the portfolio to further diversify into newer asset classes and less correlated asset classes, which makes the portfolio more resilient to market shocks and gives us real chance to outperform into the future. As we've moved into private asset classes, we're doing it in a differentiated way and in our own style. So in private equity, as the example, we're utilising our team, our reputation and deal flow to be able to partner with people to provide partnership capital for the long term as opposed to just buying out their business. And in credit, we're providing structured solutions, again utilising the experience of our broader team to provide highly flexible solutions to difficult situations. We're now in a very strong position.
We can go to places where other people can't because we're long-term thinkers. A lot of people, for example, private equity, only have money for 4 or 5 years. So they have to make that work. A lot of times if they can't make it work, they've got to bail out at a loss. Whereas we're happy to hold that investment for a long period of time. We started off with private equity. New Hope was private equity. NBN Television was private equity. So we've been in private equity probably longer than anybody. And we're not constrained. We're not afraid to sell something. It's shareholders' money we're working with. If we can get a better deal for shareholders by selling an asset, we will.
The really distinguishing feature about Soul Patts is the ability to put together, the capital allocation skills required with operatorship, and it's that combination that's driven so much value for shareholders.
They are one of the great investors, always prepared to take a long-term view, to back management and to be counter-cyclical. And really, if you look at any company globally, I think we'd be very proud to put Soul Patts against them in terms of what they've delivered, for investors over an incredible long period of time.
It's the decision framework. It's the way Soul Patts goes about the business. That, I think, is the secret sauce. Yes, the things you buy and don't buy matter a whole lot. But if you think about the way you go about building this business, if you do things methodically and properly, it's amazing how they compound to fantastic returns.
It's one of the best companies and we couldn't be happier as a long-term investor. Robert's led it well. He's got a real background. He's got common sense, and that's not so common nowadays, confidence and long-term thinking, as well as integrity.
I believe the key driver of the company's success have been the people involved with it. I'm amazed that over the years they've managed, not just in terms of their ownership, their board and their key drivers, but their key executives as well, have maintained a high standing, a high ability to think things through, and indeed a real wish for long-term profitability.
Our culture has developed over a long period of time, facilitated by Rob's oversight. But one thing has always been the same, that shareholders come first, and we're here to serve our shareholders and generate enduring success.
Soul Patts and Brickworks have been two of the greatest compounders of capital that we've seen in Australia. There is no reason to believe that they will not continue to do in the future what they've done in the past.
Where we're going now, we're in 2028, we're 125 years. There's not many companies that have done what we've done in 125 years. So if we're going to achieve that milestone, I'd like to be around for that and maybe a couple of years after that. Well, good morning and welcome to Soul Patts Shareholder Briefing in Brisbane. It's a real pleasure to see so many of you here in person, and I think this is the biggest crowd we've had. We've been to Sydney, Melbourne and Adelaide, and I'm pretty sure this is correct, the biggest number we've had, so great to see you all. My name is Rob Milner and I'm proud to be the fourth generation chairman of Soul Patts. As those to you who are new to Soul Patts, we've been around for more than 120 years. We're one of Australia's oldest listed companies. What started as a single pharmacy in the late 1800s has grown into a diversified investment house with a market capitalisation of about 14 billion. Our portfolio spans listed companies, private companies, credit and real assets, including agriculture, retirement living, data centres and industrial property. While we no longer own pharmacies, many of these investments made decades ago remain our core holdings today. You'll hear more about our portfolio and our investment philosophy from our CEO Todd Barlow and the management team shortly. 2025 marks an historic milestone for Soul Patts. After 56 years, we've unwound the cross-shareholding with Brickworks. The merger brings together two of Australia's greatest compounders of capital and positions us for even greater strength and flexibility. With that, I'd like to extend a warm welcome to those Brickworks shareholders who are joining us for the first time. I'd also like to call out a couple of our staff members we have here today. We have Kieran Nolan, our General Manager, and James Vassallo, Account Manager of Building Products in Queensland. As you saw in the video, the success of Soul Patts has always been very simple. Good people. This is a people's business, and the confidence in our team is what gives us a real competitive advantage. We are fortunate to have a proven leadership team with deep experience and corporate knowledge. Collectively, they share 72 years of tenure in this company. I'd now like to introduce them to you. Our CEO and Managing Director, Todd Barlow. Our Chief Financial Officer, David Gribben. Jackie Virtue, Chief Operating Officer. Brendan O'Day, Chief Investment Officer. They are supported by a talented team of 56 employees who bring energy, insight and discipline to everything we do. We also take governance very seriously. It is a cornerstone of our long-term success. Soul Patts is governed by a highly experienced and majority independent board. The board tenure reflects the institutional knowledge. Its independence ensures strong oversight and risk management. Together with the management team, we are very focused on the long-term value creation for our now over 80,000 shareholders. Before I hand over to Todd, I want to highlight one thing that sets Soul Patts apart, is our consistency. Since listing in 1903, we've paid a dividend every single year throughout the war years, depressions, downturns, and that is a testament to our financial strength and unwavering commitment to deliver value for you shareholders. I thank you for your continued support, and we're proud to have you with us on this journey. I now hand over to Todd.
Thank you, Rob, and thanks everyone for turning up today to hear our story. It's always a pleasure to come to Brisbane and to get around the country and see many of our 80,000 strong loyal supporters. Soul Patts has always been, our purpose has always been to generate enduring wealth for our shareholders. As Rob mentioned, this is a landmark year for Soul Patts, having merged with Brickworks. On the 10th of September, shareholders overwhelmingly voted in favour of the merger between Soul Patts and Brickworks, and on the 23rd of September, the merger was implemented, creating a newly capitalised ASX-listed company with over 80,000 shareholders. This merger achieved a number of things, including a strong balance sheet to fund new investments, additional liquidity and free float, a cleaner capital structure without the cross-shareholding in place, and one board and executive team continuing the disciplined governance and capital allocation strategies that Soul Patts is known for. We have said for some time now that the strategy and our investment philosophy would not change as a result of the merger. What you see here is a decision framework through which we make investment decisions. We approach investing with a long-term mindset, strong conviction, and with the unconstrained ability to invest wherever we want and wherever we see opportunity. The portfolio is constructed to generate cash, outperform the market, and importantly, employ less risk than the market. Let's take a look at how we have performed in these three pillars over the last 4 years, which is the time that the Milton merger was implemented. Firstly, cash generation. This is one of the key planks to our continued success. It's important because we pay our dividend out of the cash that we generate from the portfolio. Since FY22, our net cash flow from investments has grown at 16.5% per annum, which, as you can see, is an extraordinary result against a backdrop where the market has grown the dividends in quite a minute way, really. It's been 13% growth over the last 4 years compared to our 66% growth over that same 4-year period, which tells you that the portfolio is in good health when it's spitting off that much cash. Secondly, we want to grow the portfolio, growing our net asset value by shares on a per share basis. The growth has been over 10% per annum, which has outperformed the index each year by 1.6%. Now, thirdly, it's about managing investment risk. And as I say, this is quite an important pillar for us. It often gets overlooked because it can't be quantified. But what is important is that we are employing tactics and strategies where we are creating a portfolio of very resilient businesses that will perform through the cycle. And more importantly, they're uncorrelated to each other, which means that they will perform differently through the cycle. And by having that diversification, uncorrelation, and picking businesses that we think will perform quite well no matter what the market conditions, we've created a very resilient portfolio. And that portfolio is actually more resilient now than it's ever been. But if I look at the last 25 years, you can see on the right-hand side of this slide, whenever the market is negative, and it's negative about a third of the months, it draws down over 3% per month. And in each of those months that the ASX is negative, we do more than 2% better per month. So what we're doing is protecting capital. And it's a big source of our outperformance is to protect capital on the downside. And I don't think that there's a more important time than the current period that we're in to think about protecting the capital of our shareholders. Turning now to the slide on cash generation and importantly what impact that has on dividends, we've had a stellar track record, as Rob mentioned, of delivering dividends to our shareholders for over 120 years. But if I just look at the last 27 years, we have a remarkable achievement of being able to increase the dividend year on year, which no other ASX listed company has been able to achieve, and the next best is a long way behind us. Not only have we grown the dividends year on year, but we've actually averaged growth across that 27-year period of near 10% per annum. But what you can see here on the right-hand side of this graph is there's been a step up in the growth of the dividends in recent years as we've repositioned the portfolio and built out the resilience of the portfolio. That gives the board more comfort to be able to pay out higher dividends to shareholders, and whilst continuing to believe that we can continue that growth in dividends into the future. We have proven over a long period that our investment style can outperform all types of markets. We often talk about the power of compounders. You can see in this chart how this has been successful for us. We have outperformed the index significantly over a range of time periods, but if I draw you to the 25-year track record there, we've generated more than 5% above the index year on year for 25 years. So the effect of that compounding you can see is very significant. An investment in Soul Patts 25 years ago will have increased by 24 times, whereas an investment or an equivalent investment in the market would have been under 7 times growth. So that benefit of a little bit of outperformance continued year on year compounds up to a lot. But what's more important is that we've been able to deliver that kind of growth and that kind of shareholder returns whilst employing those strategies that I mentioned overall are less risky than the market at large. So briefly touching on the portfolio, as at the merger we had $13.2 billion of assets spread across a number of different asset classes. For those shareholders who are familiar with how we categorise those investments, you'll notice that there's been a slight tweak or change in the way that we describe them. It doesn't change the way we think about investing. What is important is that this is one portfolio. It's managed by one team, and it's just a collection of assets which we think together perform very well. Our entire investment team chases the very best deals that they can find, and we deploy our capital to whichever opportunity provides the best risk-adjusted return. And then we try to evidence the diversification of the portfolio in a slide like this, but we don't actually allocate to these different asset classes from a top-down perspective. What we're doing is just making good new investments all the time, and then employing a risk overlay to make sure that the portfolio as a whole is appropriately diverse and uncorrelated to be able to achieve our objectives. We're also maintaining liquidity to take advantage of attractive new situations that may arise in any challenging markets that we may face. Each of our asset classes by design offer different risk-return profiles, and as I said earlier, importantly they perform differently through the cycle. What you can see here is a deliberate shift towards more private investments over the last 4 years. Just prior to Milton, we had less than 11% of our portfolio in private assets, and following the merger with Brickworks, nearly or half of our portfolio is in private assets, which is a very deliberate shift because those asset classes exhibit different qualities that we're seeking in the current environment. Doesn't mean that we're going to be fixated on having half of our investments in private asset classes. It may go up, it may go down, it depends on the market environment and also the opportunities that we're seeing. But you'll hear more on why we've consciously increased our private investments as we go through the presentation, the Q&A today, and we hear from the team. But I'll ask Jackie Virtue, our COO, to come up and start asking some questions of our team, but then we'll open it up to shareholders and hear any of your questions, and look forward to them. Thanks very much.
Thanks so much, Todd, and welcome everybody. I just wanted to echo the welcome from both our chair, Rob Milner, as well as Todd Barlow. I think we were here earlier in the year, early April, so there are some familiar faces. There were far fewer people in the room at the time. I think I heard somebody in the room say, well, maybe that's because the cricket wasn't on then. But hopefully it's also welcoming our new Brickworks shareholders and providing the opportunity to give you a bit more context and understanding of Soul Patts and how the portfolio works. So Todd, just before we take a deeper walk through the portfolio, when we were talking about sort of the three pillars of how we deliver value to shareholders, I'm really even more curious about the risk management. I think it's quite intuitive when you talk about growing the portfolio and generating cash. But that sort of risk management is really interesting, because if you're a shareholder and you're thinking about risk-return trade-offs, or if you're a new investment portfolio manager, you often hear about the fact that if you're increasing returns, then you have to be increasing the amount of risk that you're undertaking. But the way that you described it, it's not quite like that. So I'm really interested to hear how Soul Patts approaches it in more detail.
Sure. I mean, generally that is the case, that the more risk or more return that you're seeking, the greater risk that you're employing. But we are constantly hunting for those dislocated opportunities where we can get excess returns for the risk that we're employing. And because of the flexibility that we have and the long-term nature of our capital, many of our competitors don't have that ability to hunt for those types of opportunities. And so what we're looking for are those things where we can deploy our capital and the unique competitive advantages that we have to exploit those opportunities. So really what we're trying to find is as many investments as we can that are delivering a little bit more return than should be the case for the risk that we're employing. And that's the first step. The second step is to fill out the portfolio with uncorrelated asset classes. And what that does mathematically, but even intuitively, is that you're protecting your downside, because the assets that we have in our portfolio, as I said earlier, perform differently to each other through the cycle. So when one is down, another one might be up. And so what that's doing is shielding us from volatility and reducing our overall risk. And again, that's not something that many people can do because most asset managers are only looking after one particular asset class. They're not doing what we're doing, which is have the flexibility to diversify across different types of assets. So there's a number of techniques that we use through our portfolio which have enabled us to be able to generate higher returns in the market whilst employing less risk. And it really is a fundamental principle of ours to protect capital on the downside. It's very important because our shareholders rely on it. And as I said, it is a way of us generating outperformance.
Perfect. And Todd, you touched on sort of the diversification and low correlation among assets. Brendan, I know that that's something that you focus on quite significantly. Maybe you can just touch on that as we think about moving through different economic cycles and particular areas that you might focus on that will present those opportunities.
Sure, and I'll echo everybody's earlier sentiments about how good it is to be back here in Brisbane. I think we've got double the number of people this time around, which is great to see. This is definitely the flashiest room that we visit, so hopefully we get a good rate on it, otherwise we'll upset Jim, right? But the question was around diversification and assets, and Todd's touched on and done a very good job of describing diversification, how we think about it. A well-known Nobel economist described diversification as the only free lunch in finance, and we think about it that way. If you put two assets together that return exactly the same way, and put them in a portfolio, your combined returns can often be higher, but your risk is always lower. And we think about diversification that way. But for us, diversification is not just about throwing a whole bunch of assets into a bucket. It's not a particular number of assets. In fact, you don't need a lot of assets to achieve this. You just need assets that perform in a way that are different to each other. And if you look at the history of Soul Patts, we've been frankly blessed by having 3 very strongly performing assets over a long period of time in Brickworks, New Hope and TPG that happened to be relatively uncorrelated, and we generated very, very strong returns over a very long period of time courtesy of that. But as we look into each of the portfolios, a unique ability of ours is to look at opportunities across multiple asset classes. It could be in private credit, it could be private equity, it can be listed equities, it could be in real assets, or we could be in cash if we chose to. And all of those assets that we have in our toolkit allows us really to go after diversity in the right way, which is putting assets into the portfolio that we think are going to perform really, really well, that just happen to work very nicely together on a diversified basis.
And of course, David, that's all very well that our investment managers come up with these ideas and unique opportunities, but it's not really going to work unless we have the liquidity available to be able to prosecute the ideas. So as CFO, puts a little bit of pressure on you.
Yes, so it means that I've got to be pretty good at tap dancing. As Todd said, we're investing your money, it's permanent capital. The investment portfolio is opportunity-led and things flow to the best return we can get at the lowest risk we can take. So to do that, we make sure that we maintain a good, healthy cash buffer. So at the moment, we've got about $100 million there to make sure that we can invest when we need to. We also make sure that some of our assets are liquid in the sense that we can turn it into cash quickly. So, over 30% of the portfolio is in listed stocks. So if we needed to, we could sell that. But more importantly, if we don't want to sell, and that's because maybe there's a market dislocation, it's not a really good time to do that, we're able to leverage the portfolio or borrow or use those assets as collateral to turn that into cash. So we have all those different levers there just to make sure that when the investment team comes up with a fantastic idea, we can actually execute on it nimbly, quickly, and again, that all goes to part of the strength of how Soul Patts invest.
Absolutely, and thank you to the three of you, because I think that hopefully builds out those strategic pillars with a bit more context as we start to sort of move through how the portfolio works and what's in it. You see on the screen there the evolution that Todd touched on, moving from sort of 11% private markets going into 50%. Of course, the anchor tenants in that listed space was TPG, Brickworks and New Hope, which we touched on. Do they still play an important part in the portfolio?
They do. And maybe to sort of answer this question a little more broadly, listed equities are important to the overall portfolio. If you go back, they were the cornerstone of our performance over a very long period of time. And in fact, listed equities, and particularly Australian listed equities, have been amongst the best risk-adjusted returning asset class for decades. And Soul Patts have benefited from that, and you as Soul Patts shareholders have benefited from that. And so listed equities are really important to us. So listed equities do a host of things for you. They provide you with the opportunity to invest in a business that can compound its earnings over a long period of time. So we look for assets that compound over time. We look for businesses where we can understand the valuations. We look for businesses that flow a lot of income, and obviously income is important to us. It's the bedrock of our dividends that we pay to you all. But Aussie equities have an extra kicker, which is nice, which I'm sure everybody in this room is fond of, which is franking credits. And when you put franking credits together with income, together with capital gains, you end up with an asset class that provides very, very strong post-tax returns. And we've enjoyed that as Soul Patts for a long, long time. It's a smaller part of the portfolio now. And that was very deliberate on our part. We saw some really strong opportunities to invest in private assets. We were of the opinion that the equity market more broadly was a little bit expensive. So we've taken the opportunity to make that a smaller part of the portfolio right now. And what we've done in that process is gone from a large portfolio in terms of the number of investments. It was probably about 100 shares at the time of the Milton merger. It's now about 35 investments. So we think there's still money to be made in listed equities, we really do, but I think the job of us making that money right now is a little more complicated. I think you need to be very specific about your investment. You can't rely on the broader market lifting all boats. I think a few of you may be LIC investors and you may have observed that's been a more difficult place to invest lately because that kind of tide rising all boats has not been a factor really over the last few years. So we've really focused our portfolio down into a smaller number of investments and investments that we can really get deep into and understand, and we think we can extract a lot of value that way.
Is the cash flow generation from those assets or in this asset class still very important? Very important.
It's important for two reasons. Obviously, it's important because it does allow us to pay dividends to you all, and I know how much you all love that. So 65% of our income comes out of this portfolio. There's some concentrations around that, which I won't bore you with, but it's a really important portfolio for us in terms of income generation. So we have that in mind. But cash acts a little differently for us. We view our world through the lens of cash generation, which means we view our investments through the lens of cash generation. We're attracted to businesses that generate strong cash, if not now, but certainly in the future. And if you look through all of our portfolio, it's very rare to find an investment that we don't think is going to pay us some cash at some point in time. So cash is king. DG would tell me that P&L's a fiction, but cash is fact, right? Or something like that. I probably messed up.
No, we'll get to that, I'm sure. Yeah. And our shareholders can see on the screen we've got some statistics in relation to our listed companies portfolio, but on the right-hand side you'll see there is a case study in relation to TPG, which we mentioned was one of those sort of three anchor tenants. One of the really interesting things about this, it demonstrates that one portfolio approach and shows the evolution and how it can move through asset classes. And Rob, I think TPG was actually in the private company's portfolio when you just joined the board.
As I mentioned there earlier, we were probably the first into private equity. Obviously, it all started, TPG all started when you guys will remember Christopher Skase and Alan Bond devastated the free-to-air networks of 7 and 9. And there was another Western Australian called Kevin Parry. He bought the TV station in Newcastle and, of course, devastated it. They used to have a helicopter in those days. He used to fly people up for lunch. $800 an hour to run the helicopter. They used to go up and have a good lunch. So anyway, they went broke as well. So we bought that TV station for $38 million. We then, digital TV came into advent about 5 or 6 years later. We started up a little telecommunications company called Soul Pattinson Telecommunications. Some of you may have been shareholders in that little vehicle. And then we sold the TV station when Packer sold Channel 9. We sold the TV station for $250 million. And some of you in this room will probably have TPG shares. You would have just received a $1.61 return of capital. And Soul Pattinson just had a nice little cheque of $380 million. So this has all come from a $38 million investment. And then David Tia, who was chairman of TPG, was a Malay Chinese. And he was very switched on and thought that a disruptive telco in Singapore could work. And I don't know whether any of you have got QAS shares, but it's now a very, very profitable little business, and we still own quite a large shareholding of that. So that all started from a $38 million. The trouble is, Todd and his team, we keep trying to find these sort of businesses, but they're not there anymore. The bargains like this. But it just shows you how you can compound some investments. And New Hope's another one. I think our average cost of New Hope is 4 cents. You know, and their market cap today is about their market share price is $4. So, you know, if you're patient and you're a good investor and you have good people running these businesses, not only within Soul Patts who have had good businesses, we've had some very good people like Kieran and other people that have run our investee companies. So it's one of the reasons why we're sitting here today with a market cap of $14 billion.
And I think it also speaks to our flexibility because you know, I think a lot of other fund managers, as a business grows, they would then say, I'm too concentrated in that position, and they would be forced to sell down. Whereas you know, our principle is let our flowers grow, and it really has been something that has grown significantly. But in addition to that, it moves through the portfolio. So we have 2 assets in our emerging companies portfolio. This started out as a private equity investment, moved into our listed equities portfolio. So we don't have a fixated view about where things sit in a portfolio and how the portfolio should should be comprised, and that flexibility is really what has enabled us to be able to get these generous rewards.
As well as, I think, the patience that you pointed out, Rob. We still remain patient, and those opportunities will present themselves again in different kinds of markets. So I'm sure that will long continue.
Not many people have got rich overnight.
No, that's right. And on the screen you can see that the capital redeployed from our listed companies' investments has been about 1.4 billion. That's quite a lot, Brendan. Do you expect that trend to continue?
Maybe. I think the important point here is we don't sit around the board table as an investment group and seek to allocate to individual buckets. We're not looking to put some money in private and some money in private credit and equity and cash. And we don't approach it that way. We approach it from the investment up. So the large reason why that portfolio has got smaller over time is we've just found some other great opportunities elsewhere, and we've had the opportunity in the listed portfolio to fund it from there. And one of the nice things that listed equities give you, obviously, is the ability to either lever them, which we occasionally do, or sell them and reinvest them elsewhere. So what you've seen there is probably a combination of us feeling like the equity market is a little fully valued, but mostly it's been us finding some really good opportunities, particularly in private credit, to grow the portfolio. So may it continue? It may continue. If we find some other really good opportunities, it may continue. But if the equity market were to provide opportunities for us to grow that portfolio again in a way that made sense to us, it could easily go back the other way. So it talks to the flexibility that we have in the portfolio and the willingness of us to be clear-eyed about the investment opportunity and not really attached to any particular stock or situation. And that's really quite unique in the investment world. Todd touched on this idea that other asset managers are constrained by mandates and rules and regulations, and we're not. I mean, it's a real source of advantage for us. If we see an opportunity, we like the look of that opportunity, we can go to places where other people can't go, and we will look into our portfolio and find the thing we like least and use it to fund the new thing that we like better. And it's quite a different way of operating your portfolio. It's unique, and it's a real source of advantage for us.
And part of those that redeployment of capital, I guess, has moved on to another part of the portfolio, which we refer to as emerging companies. Interestingly, when you look at the emerging companies portfolio, kind of wonder why that's been carved out separately from listed companies. Aren't they the same?
Largely, I mean, I think a lot of the, you can see on the black column here, most of it is listed companies. There's a small proportion of sort of listed companies that we support even before they've done their IPO, but it is largely a listed portfolio, but it's different. And as Rob mentioned, we're constantly looking for the next big thing. And so I think people are, probably think of Sols as being a pretty conservative investor and not a high growth investor. But talking to that earlier point that we were making around portfolio management, you end up with a steady portfolio, but underneath there is actually a whole lot of different things that are performing in different ways. And one of the things that we're looking for is high growth businesses. And so we have a really, really solid allocation in our portfolio to things that have the capability to grow a lot, and we're trying to identify things that are in their emerging phase. And that doesn't mean that they're small caps. It just means that we think that they are high growth and may not be a big dividend payer. So in our listed portfolio, there's a real focus on extracting dividends, and Brendan mentioned the franking credits attached to the listed companies portfolio. But in this case, it's sort of low dividend yield because they are ploughing all of their profits back into growth. And it's been a phenomenal performer for us. I mean, just in the last 4 years, this portfolio has grown at about 18.8% per annum. That's well above Small Ords index that I think has only done about 4 or 5% over the last 4 years. But companies like Tuas, Apex, our Malaysian listed healthcare business, uranium company NextGen in Canada. You will have seen recently Monash, IVF is something that we're looking to get more exposure to. So we're just trying to find these businesses that have capability to be a lot bigger than they are today, and hopefully they grow into much bigger investments for us over time.
And Rob, am I correct in recalling, I think it was before my time, but you had a hand in running this emerging companies portfolio a little while ago. Is that still the case?
No, not as much. I always employ people that are smarter than you. No, obviously, over the years I was very involved, but one thing I don't miss anymore is sitting hour after hour in the meeting rooms talking to people, with people coming in to sell you things, and that's probably one of the things that highlights what the boys have been saying. 5 or 6, 7 years ago, people used to come to us, and I always had the feeling that it had been shopped around town. Then we might have been 6 or 7 on the list. Now, with what these guys have been able to do, if there's a good business in town that someone wants to talk to you about, we're 1 or 2 on the list. And I think that's been one of the greatest things we've been able to do through our success and confidence and our reputation, that people have got to know us over a long period of time, that we're a good, well-run company with honest people running it. So.
And is that true, your views in terms of the rest of the portfolios that are managed, in terms of your involvement in them?
Yeah, as I said, we've been in a lot of different things, and my role nowadays is mostly sitting on boards, so I'm not sort of day-to-day running of the business, but we've had, and we've never shied away from a business if we've discovered that it had good people running it, and again, as Todd's mentioned, cash generation. One of the reasons why we've been able to continually up the dividend and pay a dividend over 127 years is we've had good businesses that have generated cash. As I said, TV, coal mining, we're not afraid. Monash, we're not afraid to go anywhere as long as it's got good people.
And I guess in the emerging companies, we heard about TPG as being a phenomenal investment before, and EOS is also an interesting case study. It shows the fluidity of some of these investments across the portfolio. I think it started out with equity, moved into credit, and now is in emerging. Did you want to touch on that particular investment, Todd?
Yeah, that's right. I mean, we identified EOS a long time ago as an emerging defence company, and we were a shareholder. They got themselves into a position where they were short cash and actually were in quite a bit of trouble. We came in with a complete recapitalisation plan, which was about a $80 or $100 million solution for them. And they were almost at a point where the equity was wiped out. They were going to call in the administrators if we didn't come to their rescue. And so we came up with a solution that worked for them. We made good money out of our credit solution. We also became a 10% shareholder in the business. And from what was potentially a zero for shareholders is today, a multi-billion-dollar company. And that's in a relatively short time. So it shows our ability to work with companies, it shows our ability to be flexible and come up with solutions that suit their needs, and also, it's been a very successful investment for us as well.
And of course there was the credit component, and really that the structuring and the bespoke nature in terms of finding solutions for clients was so important, and is quite indicative of type of activity that we have in the credit asset class. How do you think about the differentiation for us around credit?
Well, we're very differentiated in the way that we think about credit to the rest of the credit community. I would say that the way that we think about credit as against anything else we're doing in the portfolio is not so different. We look at a business and we look at an opportunity to back a growing business with good management, and we just find a solution that fits their needs. Now that might be an equity investment, it might be a listed investment, it might be an unlisted investment, it might be a credit solution that they need. And there's a range of reasons why someone might not want to raise equity. Maybe they think that their share price is too cheap and they don't want to raise equity here, but they do need money. And so then we can come up with a structure where we can give them some debt and charge them something that gets our returns that we desire. It might be something much more than they could get from the bank, but there might be reasons why they can't go to the bank. I mean, in our credit portfolio, if any of these people could go to a bank, they would, because it would be cheaper. This is a portfolio that over the last few years has generated circa 14% returns. Now, you can only get that by employing a structure that's highly flexible and solutions-based. So we don't think we're taking necessarily more risk, we just think we're being more flexible. And so we look at it in the same way that we would think about an equity investment. Is this a good company? Is it fundamentally strong? What's the valuation of this business? And what would it take for it to go wrong? And the additional benefit that we have in credit is we would need to see all of the equity wiped out. So we would need to see the valuation of the business for its shareholders go to zero before we really have an impairment problem with our debt. Because the debt is obviously elevated above equity in terms of rights in difficult situations. So we just see it as a way of protecting our downside. Now, we give away some of our upside because we don't get the unlimited equity upside that other shareholders are getting. We're getting a regulated return based on our interest rate. But to us, it's a defensive, downside protecting asset class. And it's funny because most people, when they talk about credit, they talk about the risks and they talk about when things go wrong. But we actually think equity's the area where you're more exposed when things go wrong because your equity can fall much more quickly. Whereas in credit, we have security, we have the elevation above equity. So it's a very smart way of protecting our downside while still being able to get exposure to these businesses that we like.
It's such a great example of bringing that sort of risk management to life, if you like. And of course, many of our shareholders will be reading the media quite recently where the main regulator focused on this particular area of credit is ASIC. They've been doing a lot of work around what good practices look like and have been quite vocal, calling out some that potentially aren't. How do you think about the good practice element?
Well, I think a lot of those areas of concern for ASIC don't really apply to us. I mean, what's happened is the Australian credit market is fairly early on in its development as compared to some offshore markets. The global private credit markets are massive. Here, it is really quite nascent, and so what we're seeing is a lot of new funds set up offering private credit to retail public, and they are not always doing that in the best possible way for their investors. And so I think ASIC has taken a particular look at whether they are appropriately disclosing the risks, whether they are appropriately managing the conflict of interest between the manager and the investors, whether they are employing practices that are appropriate and protecting risk for their investors. I mean, all of these things don't really apply to us. We don't have a conflict of interest because we don't have an external management company looking after our assets. It's our balance sheet that we're investing. We're not out raising money for these investments. We're protecting our shareholders, and there's no interest in us doing something that is not aligned with our shareholders. So we don't see any of those ASIC concerns as being applicable to us, but I do think that the ASIC concerns are real, and it's a focus area that's deserved.
And I think testament to you, Todd, and Soul Patts, when ASIC has actually invited you to comment along the way in terms of what their policy stance is, what does make good practice, and how do we lift the bar collectively across the industry.
Well, they put you on the panel.
Maybe turn the mic off then. We have the Australian context from credit, and I think some of those reports talk about that can sometimes sort of limit the opportunities that are available. And so is there a desire to look more closely offshore?
Yeah, I mean, as I said, the offshore credit market is much deeper than it is in Australia. This is a good asset class that we like. It fits our criteria of protecting downside and still being able to get a decent return. Globally, we've seen the price of credit contract, so the terms aren't as good as they have been in the past, but there are some very good managers around who think like us and have a very solid track record, and so we are deploying globally to people who think and act like us, and we can partner with them. And so we're up to about $700–800 million of offshore deployment to really high quality managers that we've sourced, because we can't do these deals offshore. We don't have the network, we don't have the boots on the ground. We're not going to attempt to try and compete with a very deep and established marketplace. So we're just investing with them, and I think that's a good way to get exposure.
Really interesting opportunities for expansion. Well, we might, with that, move across to the private companies portfolio. This is something we had historically referred to as private equity, but it was a deliberate change in the way that we reference this asset class, Todd, mainly to provide some context in terms of our approach and our philosophy. Can you describe where we differentiate here?
Yeah, I think the term private equity is probably viewed as the way that most of private equity managers operate, and that is essentially a leveraged buyout model where they take 100% of a business and put lots of gearing in there, borrow lots of money to be able to extract higher returns. Now, we think that has a couple of risks attached to it. One, when you employ a lot of gearing or a lot of debt into your acquisition, if there's any kind of hiccup along the way, then you can get yourself into a lot of trouble. So we don't leverage our returns. Secondly, when you try to buy out 100% of a business, you can really only do that in a couple of circumstances. One is where there's an auction, so somebody who doesn't want to own their asset anymore has decided that they want to sell it, and they'll sell it to the highest bidder. We're not really interested in participating in an auction and paying the highest price to secure an asset. The other way that private equity buys assets is to look at a listed company and then pay a premium above the listed share price and pay shareholders an offer they can't refuse. Again, that doesn't really sound like a model that we should always chase, notwithstanding that we made an approach to a listed company a couple of weeks ago. But generally speaking, we think the better approach is to partner with people who love their business, they don't want to sell, but they're just growing and need capital to help them along the way, and they want a long-term capital partner. And so we think that we have a particular opportunity with our flexibility and our long-term approach to partner with very high growth businesses that just need capital. And funnily enough, that seems to me to be a better way to approach private company investing, but the competition for that kind of capital is not very high. There is not a deep pool of money that is available to partner with people for the long term in private businesses.
And David, you don't necessarily manage this particular portfolio, but as CFO, it adds an interesting level of complexity to your day job. So with that, maybe you could tell us a little bit from your perspective what's in the portfolio, and we have 4 interesting ones on screen, perhaps why we've highlighted those ones in particular.
Yeah, thanks, Jackie. And as part of my job is really helping out those management teams, particularly when it comes to financial issues. But this portfolio has been put together, or this asset class has been put together in a very thoughtful and disciplined way. So it's collected around themes, things like where we see there's long-term tailwinds or there's demographic change that really means that those businesses are quite resilient through the economic cycles. And we focus on things that Australia is good at. So things we can see long-term increased demand for energy, the energy transition, so things like AMP control, tap into that world, education, and we've got the Carlisle Swim schools there, which is 30-odd swim schools, mainly in Queensland and New South Wales and Western Australia. They do close to 40,000 lessons a week, and if you've got young kids and want them to learn to swim in Australia, well, you'll always want to pay to make that happen rather than go and put your money into Netflix or something like that. Financial services, with the compulsory superannuation and the ageing population and the intergenerational wealth transfer, something like Ironbark is really well placed. They look after about $80 billion worth of other people's money in wealth management, financial advice, corporate trustee, and helping out people's portfolios. So there's some science behind what we're investing in. And as Todd said, it's really all about that permanent capital, partnering with good leadership teams to then, outside the glare of the public eye, if you're a listed company, you're out there every 6 months having to explain what's going on, they can just crack on and grow the business.
And that's a great description of what's in the portfolio. The focus on Australia having a competitive advantage in particular, really good thematics there. But Todd, is there also an international aspiration or ambition for that portfolio as well?
Well, again, there is a deep pool of opportunity offshore. Australia is a relatively small part of the global market, and when we're looking at finding these partnership opportunities in fast-growing businesses, there's even less opportunity in Australia than there is in listed markets and things like that. So we've found, on our endeavour to partner with good offshore managers who can find these asset classes, we've found a couple of good people to partner with, and through them we've identified a number of investments in the US. So we now have exposure to a range of. We have wealth management in the US. We are exposed to a coffee chain in the US, which has actually just gone public, and we've made very good money on that already. There's a Portaloo business based out of Tennessee that's growing rapidly, a window manufacturing business in Florida, an air conditioning business in San Francisco. All of these things are businesses that we would never have been able to find directly, but we have partnered with people on them, and and it is not unusual because of the size and opportunity in the US market in particular to have several $100 million businesses growing at 20 and 30% per annum. There's not many of those companies in Australia, so that's one of the reasons why we're looking offshore.
Fantastic. And just for our shareholders, when we move to Q&A, if anyone's interested in the application of AI, one of my favourite anecdotes from Todd is around the Portaloo business. So if you want to drop that question in, I'd love to hear it. And so we finally move on to the real assets asset class component of our portfolio, which is, I guess, it's a new classification. We've got some new entrants into our broader portfolio that fit in that category, as well as some existing ones that have been around for a little while. David, maybe you can take us through what's in it and why we've aggregated those together.
Yeah, so real assets, it's obviously things that you can sort of see and touch. So it's industrial property, it's agricultural assets and their facilities, it's retirement villages, and it's things like water rights, which are particularly important with an agricultural investment. So we've always had that as part of the portfolio, but with the merger with Brickworks, obviously we've brought in their $2 billion industrial portfolio, where they've been able to recycle surplus land, partner with Goodman to create these enormous industrial parks in Western Sydney, Brisbane, and hopefully Melbourne. So it's a great collection of assets, very good inflation protection. Real assets tend to improve in value in times of inflation, but things like industrial property assets also give a very reliable cash flow. So they're long-term leases with really reliable tenants, so you can always bank on those rents, but of course they also link to CPI as well, so you get that on the income, not only the capital side, you get that inflation protection there as well.
So does that mean you consider them to be passive?
Well, that's the thing about this portfolio, is that those assets, they need to be actively managed, but we also have development opportunities in there which allow us that we have a mixture. It's probably 2/3 are stable assets, so they're fully developed, earning income, and 1/3 is really things that we can see potential in the future. So things like data centres, where again That's part of the energy transition, but also AI, the long-term demand for data, all support the data centre piece. Obviously, with the industrial parks and e-commerce and logistics, online shopping and all of that type of stuff continues to grow, so we're well exposed to that. And as we all get older, there's an increasing demand for high-quality retirement assets, and we've just finished one development down in the beach in Cronulla and Sydney, doing another one in the northern part of Sydney. So all of these are really longer term aspirations. The agricultural portfolio, food security is a real worldwide concern, and we have we're developing a significant portfolio in citrus, table grapes, apples, kiwi fruit. So they're things that we can see long-term prospects for all.
Do you think our competitive advantage or our points of differentiation in this particular asset class are as obvious as the other asset classes that we've covered?
Well, we apply the same principles that we do to the rest of the portfolio. So, Rob talked about, finding a gem and then, working with it and polishing it up, and all of a sudden you've got something that no one would have thought was there. So the same principles that we use, the flexibility, the nimbleness, the smarts, all go into constructing, fantastic investments.
Fantastic. That is, I think, a really great walk through each of the different asset classes that fits within that broader portfolio that Todd described at the beginning. So just before I open it up to the audience for questions, I thought I would just close with two final questions, one for our chair, Rob Milner, and one for Todd Barlow, CEO. Rob, really importantly, we talk a lot about people and culture. You had David Gonski on the earlier video talking about how he's seen that very clearly for some years. I'd love to hear your perspectives. You're a fourth generation founding family, and it seems to be a culture that has persisted over time. How do you think about it?
When I was asked by my uncle, who was a previous chairman, in 1984, would I like to join the board? And obviously I'd been keen on investing before that period of time, and over the period of time since 1984, I've learnt that the culture within this organisation, and again, as I mentioned before, with our investee companies, is quite staggering. As we mentioned before, I think we mentioned 58 people work for us. They come in every day. They want to come to work. We're not a Westpac or one of these accounting firms that people work from home and come and go as they please. We have this culture where people want to come into work. We make it attractive for them. We've got a Christmas party on Friday, and every Friday afternoon the bar's open. And but these are the sort of things you have to do to make, in this day and age, to get people to come into the office and make it a place where they want to come and enjoy working. And for some reason, I can never. I've asked this question quite often. I just can't answer why it is, but we've just been able to develop over a long period of time. It was in the generations before me that it's always been an excellent place to work. And again, I think you see with these younger guys and Jackie and Tani, who's organised the function for us today, it's a business where people want to come and work. It's something I can't really tell you what the point is, but it's a culture that we've had, and I just hope over the years to come that we can continue to make it I would hate to have one of these people that I wake up in the morning thinking, oh shit, I've got to get up and go to work. I think you've got to be incentivised to jump out of bed and say, right, it's another day, it's Wednesday today, I've got this to do and that to do, and we're very lucky that we've been able to, and I think that's proof of the pudding that we've done what we've done long period of time.
And I think that's a great description. We were talking about that, I think, on the plane in terms of jumping out of bed and actually wanting to go to work and how soul-destroying it would be if you didn't. And we see that also in our junior employees, because the opportunities that the team here have spoken about today, imagine being a younger kid working on those types of opportunities. I don't think it gets much better than that. And Todd, just in closing, the growth of this organisation under your stewardship as CEO for the last 10 years has been quite phenomenal. What excites you about the next 10 years?
Well, I think we're actually strategically in a very, very strong position. Over the last 4 years, you can see the efforts that we've made to build out the portfolio into different asset classes. So we now have a foot in a lot of different camps, which means that we're now in a better position than we ever were to be able to seek out those opportunities from a wider source, and that includes offshore, which is something that we hadn't done previously. So for the longest time, we were heavily invested in the ASX, and we did that in a very solid way, but now I think we're in a much better position to go hunting in a broader cross-section of opportunities. So I think that's pretty exciting for the team. It's pretty exciting for shareholders because we should be able to get better results or better outcomes as a result of that, and at the same time reducing the risk, which I think is important in a very volatile and uncertain environment.
And the other point I should mention that obviously these younger guys we've got in the office, they're at the point now where people like Macquarie Bank and these other people, they know how good they are. So we've got to make it a good, pleasant place for them to come and incentivise them, of course, to get them to stay with us because, as we all know, we've all run businesses, it's very hard to get good, reliable people.
And yet our turnover is super low, so you're doing something right, Rob.
Yeah.
Well, thank you all so much for listening to the overview of the portfolio and a bit more context on Soul Patts. We'd love to open it up to questions and to hear from our shareholders. And we have Tani. You going to ask the AI question? Yeah.
My name's Frank Hart. I'm a shareholder. I have about 350 some shares. The question I have is TPG and NHG, New Coal. That by the portfolio, when you look at it, that makes up more than 50% of your portfolio.
No, it makes up about 50% of the listed portfolio. So if you look at the portfolio as $13.2 billion, they would be close to $1 billion each. So it would be 15 to 20% of the portfolio in those two.
Well, now, looking at this, I mean, the shares for Soul have gone down about $4 since September. And then in November, TPG, they had a $2 drop in share, and they're only now at 3.77 cents per share, approximately. And the same with New Hope. They've dropped $1 a share, and they're at 3.87. So they're dropping 20-30%.
The TPG dropped because it did a significant capital return. So when they sold an asset this year, they had a whole lot of cash and then they distributed that to shareholders. So what you see when you get a capital return or a dividend is that comes off the share price. So that was the main reason there. In our case, we've had a bit of volatility in our share price around the transaction. There's a lot of activity as the composition of the shareholders changes a little bit, particularly with institutional shareholders. So that explains a little bit of that volatility.
That was $1.61 I mentioned, and then to create some more liquidity, they raised some more capital at a 5% discount. So that's why the share price.
But more broadly than that, I mean, we have no issue really at all as an organisation around having very concentrated investments. You know, both of those investments that you talked about have been extraordinarily successful for us over a long period of time. The reason why they're so large is because they've grown so well. And we're not going to sell an investment just because it gets too big. That's not the way we run the portfolio. It's not how we think about life. We retain investments in the portfolio if we feel strongly about their future prospects. And we feel strongly about the future prospects for both of those investments. So, and if we didn't, we'd be having a different sort of conversation. And the volatility in the market is part of being in listed equities, and we're very familiar with that. We've been doing that for a long period of time. We're okay with that. But I very much hope we find another investment in our portfolio that turns out to be $2 billion in size. That'd be us doing our job well.
Thank you. Arthur, we'll just come back to you in a moment, sir.
Thanks for that. I've got two questions. Firstly, given the size of the organisation, it feels like you have capacity for a couple of big deals. It's actually a question of your debt capacity, your attitude to debt. It feels like you could do $1 billion deals without too much stress. And it's not completely true that you don't gear up the returns because you've got certain debt and property and there's bits of debt around. So you want to just update us on how you're thinking about debt, given how big the portfolio now is, and then go forward.
Sure. So when I talked about that we don't gear returns, I mean, we employ appropriate amounts of gearing across the businesses that we're invested in, but that's differentiated from private equity that's putting extreme amounts of leverage in to gear their investment returns. So we think about just operating leverage, which is appropriate for a lot of our businesses. But even if you look at the industrial property assets, they are something like 25% geared, so under geared as compared to equivalent investments in that asset class elsewhere. But broadly, at the sort of portfolio level, we would employ leverage, and we have employed leverage before, and we would do that if we thought that there was some fantastic opportunities and it was the right time. So if we sort of think through the investment cycle, there'll be a period where asset prices look very cheap, and there's lots of opportunities for us, and we can go shopping, and that's a good time to take on a little bit of debt. When asset prices look pretty expensive, we think it's the right time to be net cash, and that's where we are now. I think most asset classes have had a very strong run for a long period of time. I'm not necessarily saying that there's a crash coming or that we've peaked, but just through the cycle, this feels like the right time to be net cash. So that's the position that we're maintaining. We do have leverage, but it's really just about timing of different investments that we make, and then we will ensure that the cash position takes us back up to a net cash position overall. But in terms of our capacity, you're right, there is an opportunity for us to do much bigger deals. But given what I said about asset prices at the moment, we find it harder to find those dislocated opportunities at scale right now. There will be a time where those opportunities will come to us, and they will be cheap, and the equity markets will run away, the debt markets will run away, and the opportunities for us to deploy meaningful amounts of money in one opportunity will be there. But right now, I think it's probably appropriate that we use a cricket analogy, given to what's happening today, that we're hitting singles, but there'll be a time where we start swinging for the fences.
Great, thank you. That's very clear. Related to that is I think the portfolio intrinsic value is higher than the number you publish, and if the stock market doesn't properly reflect the underlying value, to what extent are you prepared to buy back shares as an investment opportunity?
Yeah, I mean, that would be something that we would logically look at. If our share price undervalued our assets, one of the best things you can do is invest in your own assets again by effectively buying back shares. So that's something we would look at.
I just wondered, I noticed you always have had a shareholding in Lipo, a coal mining company. I wondered whether you have any interest or are looking at potential opportunities in the critical minerals space.
We have looked at a lot of things, and we would have little bits of exposure around the place, and certainly what's happening on a geopolitical basis in terms of the criticality of those minerals and the the defence and protectionist nature of securing supply of those minerals is something that's interesting to us. But it feels, it's a little bit speculative as well. So, are we willing to put big bets into those right now? That's not necessarily what we'd be looking for. Whereas thermal coal is something we've been in for a long time. We understand it. We equally think that energy security is a theme that we're chasing. So that's why we've always had a view that thermal coal is something that's important, because Asia is needing a lot of coal, and we think that the demand for coal will go on. But equally here, the energy, the changing energy transition that we're seeing is moving towards renewables. So one of our biggest private equity investments is in Ampcontrol, which services the electrical engineering part of the matrix. And then in the US, we think that there's going to be growth in nuclear. So that's why one of our larger investments in the emerging companies portfolio is a uranium company in Canada. So we're looking for the sort of proven businesses that we can get into in a discounted way or at an earlier stage, but it's a little bit trickier for us to invest in speculative things or things that are unproven. Our investments in those would be much smaller.
Thank you. And Tony, over in the back there.
I just wondered if you could tell us a bit about why you brought our Westpac out of Star. Did it improve your security? Obviously you didn't pay $1, but can you say why you actually brought their loan to Star to do it?
Yeah, so we are a major lender to Star, the casino operator. It's a classic example of how we look at an investment there. I mean, that is a business that is more challenging than it was when we wrote the loan. However, it has significant asset base. And so even if you didn't believe in the continued viability of the casino, although I do think it's a casino that will be viable in time, but even if you leave that to one side, it has hotels, car parks, food and beverage, entertainment venues that are worth collectively significantly more than our debt or the syndicate debt. But because of the noise attached to it, you do see some owners of that debt looking to get out of it, and they're willing to trade out of their position at a discount. And because of our confidence in the recoverability of that loan, we're happy to buy them out. And so that loan is delivering us something like 20% returns for something that is, in our mind, asset backed.
It's quite common for us as well, Todd, if I may, to run towards more complex situations. And when you see people like banks selling out of situations because it's difficult for them to get around from a policy or just headspace point of view, it's quite common for us to look at that with a clear set of eyes and see whether there's an angle for us to play. So it's quite usual to see us running towards the fire when you have these types of situations, because it's often when you get fire around a situation where you can generate your best returns. And that's kind of what's happening here. You've got a big bank selling out of a loan because they've got some internal reasons why they can't hold it, but we feel very strongly that that it's a solid risk asset for us. And you'll see this happen quite commonly across our portfolio. We're happy to ride out cycles, we're happy to be more flexible, we're happy to keep our brains on and keep our eyes clear.
That's a good point, Brendan. I mean, I think you'd be surprised at how many times big corporations make decisions for non-financial reasons. It might be the person managing that just is sick of having to go and explain to their boss about what's going on, or they're reading about it in the paper, or it's too much hard work for them and there's easier things to do. And whereas we take a completely unemotional economic view of things, and we're happy to step into that situation.
Yeah, well, my inquiry was, I just wondered if you could give us insight into the thinking behind the investment you've got in G8 education.
Unfortunately, we don't have our emerging companies portfolio manager here, so that's one that it's a relatively small position, so it doesn't come up to the investment committee. We've got people running the portfolios who are able to make those sorts of investment decisions. So it's not one that I'm familiar with. Brendan?
No, it's a smaller one. I know it's a newer position for us as well, but if you want to come by later and I can get your name and we can take that one on notice and I can get back to you with an email after we speak to Dean, who I'm sure would have a very long answer if he was here.
Just down. Oh, I'm sorry. We'll come to you next, sir.
I'd like to ask two questions. One is, can you enlighten us the history and investment case for Apex Pharmacy Innovation? The second question is, I heard you say in an interview that you would love to double the investment in private credit from 1.8 to 6 billion. What's the basis for your optimism?
Sure. You can talk about the history of Apex.
In 1950, a chap called Key came to Australia and did his apprenticeship with Sol Pattinson. And obviously became quite friendly with my uncle. He went back to Singapore, and I don't know if any of you are familiar with Singapore, but there was a chain of pharmacies called Apex Pharmacies, which he then sold to Watson's, and came back out to Australia and asked my uncle would he be interested in investing in a generic pharmaceutical business in Malacca, in Malaysia. And unfortunately, I came back last Wednesday from my last Asian meeting. We're in the throes of selling that business. It's been a wonderful relationship. His son now has been the managing director, so it's been a very good investment for us.
Yeah, I think we calculated that over the last 20 years, that's delivered a 20% annualised return for us, that investment. So it's been, and it obviously goes back before then, but we just calculated the last 20 years. But then on your other part of your question around, why would I say that I would like to allocate more to private credit? Because we're getting 14% returns with downside protection. It's as simple as that. If we could replicate that twice over, I would. The challenge is finding the opportunities. It's hard to get those because it's not a matter of just going and holding up a shingle. We've got to actively source those opportunities.
I think we've got time for one more question down the front, unless I saw somebody else's hand up. Okay, maybe we'll just do two quick ones here and here, and we'll start with you, sir.
Yeah, thanks, Todd. Just to drill down a little deeper on what you just spoke about in terms of making decisions for non-financial reasons, how much pressure does Sol come under by activist shareholders, that sort of thing, for you guys to do things for non-financial reasons, and how confident are you can push back and you don't care about the negative media exposure if it ever came?
Well, I think that confidence comes from our shareholders. We have 80,000 shareholders. I assume you all have either been here a long time and know what we're like, or have recently bought shares and understand what the philosophy of the business is. And by doing that, we're emboldened to be able to see through the short-termism that pervades other parts of the market. There's a lot of institutional shareholders who are harassing management teams for not delivering on a 6-monthly result or underperforming for a year or something like that. Whereas we're taking a through-the-cycle view, a much longer-term view, and we've always said that we're long-term, so we can resist some of that sort of short-termism. There's been periods where people have sort of challenged us on things like thermal coal, and we thought that was more ideology driven rather than economically speaking, and we were very comfortable with the ethics of our investments. And in fact, I would say that our approach to responsible investing is of the highest order. We have always taken a view that we want to look after shareholders, people, the environment, and that's what generates our long-term returns. So I think we've got a solid track record to be able to rely on, which I think shields us from some of that noise that comes at us. from time to time.
We'll just go here and then we'll come to you.
I think we only need to take one more question. There's quite a few people leaving. We're going to be here afterwards, so if we have one more question, and we're more than happy to chat afterwards. As I said, there's quite a few people have been leaving.
I'll be very quick. Trivia question first. I go to a lot of shareholder meetings in Brisbane. This is the most prestigious venue. Do we have an interesting cover? Second question is, I've got shares in AFIC, which is the Australian Financial Investment Company. At times I feel they're sleepwalking. Any chance that you might consider a takeover or
Well, I mean, we get that question a lot because, obviously we did Milton 4 years ago, and that was a good result for Milton shareholders. But that was really strategically important for us because it gave us the capital to be able to redeploy into these other areas that we've embarked on. And now that we've done that, the strategic need for us to do it again is not there. And in fact, all we would be doing if we were to buy other investment vehicles, we would just be getting larger, and the challenge of finding those unique opportunities that I've been talking about being so hard to find would be even more difficult. So it's not something that is strategic for us right now.
Great question to finish on, though. Thank you.
All right, well, thank you very much, ladies and gentlemen. As I mentioned, we will be here for a while because there's some nibbles and refreshments outside there. And I'd just like to thank Tani for organising, and Courtney, who's not here today, for coordinating this wonderful reception we've had. And if anyone's looking for some building products, Kieran's here. And you might even get a staff discount. All right, thank you.